CPAs like myself often get a bad rap, usually for being so backwards looking and not providing enough proactive, positive advice that can really make an impact on a taxpayer situation. And so when you get a chance to do that as a tax pro, as a tax advisor, a CPA, you have to take advantage of it. And one of the biggest ways that I've been able to really impact my clients' tax returns, future planning ideas, and consideration is by taking a deep dive into their operating agreement. And an operating agreement is really a business agreement that is signed and is really important when you have more than one owner. When you have multiple owners, and especially when you have when you're raising equity from investors, a lot of different things can go different ways based on what's in that operating agreement. And so I'll never forget the first time I had moved over to tax, which is a whole nother story. When I moved over to tax from audit, a client sends me their operating agreement, and this was kind of the genesis of my obsession with these. And the client says, "Let me know if you have any suggestions on it." And so I walk down to my managing partner's office and I say, "Hey, what do you do with this from a tax perspective? What am I looking for?" And he says, "Oh, just look for misspellings, look for anywhere it talks about tax, and make sure nothing looks weird." That was it. It was just a do nothing. And so, a couple days go by and I finally send the email back and said, "Yeah, no changes." But that was the start of it. It was the start of kind of my obsession with well, what am I missing? Right? Where can these things go wrong? What should I be asking for? What should I be reading? And more importantly than what's in it and what am I reading is what's not in it, right? What does my client not know about that they should know about? And so, I've spent years, it feels the last little over 10 years now, of really just taking a deep dive into the impact of operating agreements on tax returns, tax planning, legal stuff aside. There's a whole department that could be generated with work just from operating agreement language that impacts the tax code. And so what I've done today and what I've done with this most recent edition of the Plug newsletter coming out on Saturday is share a little bit, just a little bit of the insights from what I've gleaned in the last 10 years. And so I'm sharing a checklist this weekend. It's 10 or 11 points of actual real things that I'll search for and look at and read why they're important, how they impact things. It's not it's not a white paper, but this is the checklist I use. This is what I look at every time I look at an operating agreement, these things. And we can group them into sections, right? Key sections, key impact areas that I kind of look at and target around. And so today we're going to run through those three sections on this episode. For those that don't know or just joined and subscribed, my name is Roger Ledbetter. I'm a CPA out of Texas. I've been a CPA for just about 20 years. Heavy real estate and tax partnership expertise in our firm currently. We do have a bookkeeping team as well. I have a background, as I mentioned, before I came over to tax full-time, a background in audit of financial statements. It's kind of where I get some of the accounting know-how, a little bit of the small business internal control. Always have worked in a CPA firm serving private businesses. So a lot of my background comes from that aspect and seeing thousands and thousands of businesses. And so I use that and I use that background to then apply what I learned about operating agreements. And so let's get into it. Let's talk about the three areas that every operating agreement needs to touch or you should look at in an operating agreement when you're reading it for either your client, if you're a CPA or advisor or attorney, or if you're raising money. And what do your LPs need to have in the operating agreement? What do you need to have in the operating agreement as a GP to protect yourself, to protect your investors, right? How can you use this as an advantage to you, as a differentiator that's not currently out there? And so let's talk about the three things are the capital stack. So we're going to look at where's the money coming from? What type of equity are you raising? What type of debt do you have? Anything else going on that's helping finance this? We're going to talk about event-based items, right? So things that will happen that should be planned for in the operating agreement, right? How are we going to plan for these items? What tax considerations are there? And what language needs to be in there to consider those? And then the third is kind of a catch-all. I call it like a best practices. And so these are things that should be in your operating agreement, regardless, usually in your operating agreement, regardless of types of capital stack or events you'll consider. So let's talk about it. First one is capital stack. And there's a couple items in here that I really want to hone in on. And home. So the first one is income allocation. Income, and by I mean income and loss allocation. There are really three primary ways that income and loss can be allocated in a partnership. And when we say allocation, we'll just break that down a little bit. This presumes that these are in partnerships. We'll talk about S corps and TICs later on, but in a partnership, income and loss is allocated to partners, right? So think of a K1, which is what a partner gets, a tax form a partner gets. A K1 is really like their W-2. Right? And that reports to the IRS and to that partner how much income that person is getting. So just like your W-2 shows the IRS how much money you received from paycheck for income received as an employee, a K-1 tells the IRS and the partner how much income you received as a partner. It doesn't have to equal distributions. We don't have to talk about that right now. But it also includes how much loss you have received or loss has been allocated to you. Right? And so in real estate and partnerships, a lot of the times we can increase and inflate or accelerate losses that can be passed through to partners, to LPs. They can use it however they want, usually to offset other passive income. Well, the type of income and allocation language we use will impact how much of that loss can get allocated. And so there are three different ways. The first is a safe harbor method. The second is called a target capital account method. And the third is what's called a percentage interest in the partnership, which is really just a catch-all. It's kind of what the courts use, like, hey, we're gonna use our own facts and circumstances. So really you want to be either safe harbor or you want to be target capital. And there's a big difference in which one you need, right? So safe harbor is usually what you're going to use when everything's pro-rata. It's for smaller deals. It's a fairly simple equity raise, right? You're not going to have multiple layers of priority and distributions coming out. You can have a promote, you can have a carried interest that will kick in for the GP upon meeting certain hurdles. But a safe harbor is usually a simpler method, and it's when all LPs are really in the same bucket, same class of equity. They're going to share profits and losses equally, and the promote or the carried interest can kick in for the GP, the sponsor, or the syndicator, whatever you want to call them. The second then is what you would use. Target capital is then the other option, which is what you would use for maybe a little bit more sophisticated equity stack, where you'll have different priorities of equity or different priorities of units, right? So you'll have like a class A who will get distributions first. If the whole thing blows up, who gets what? Cash. Class A gets their money back first. Then class B gets the money, then class C if there's anything else. And so when you have a target capital account method and you have different tiers of these interests, you work from the bottom up. So the lowest levels of capital invested get losses first because the highest levels of capital get their distributions first, right? And so the losses and capital distributions kind of work in opposite ways. And so again, we look at target capital or we look at these allocations differently. Target capital will change how much each investor will get based on what class they're in, and that impacts losses as in kind of consideration with the distributions. And so you can see that if an operating agreement had safe harbor language instead of target capital, it's pro rata in safe harbor, usually pro rata distribution or pro rata losses based on capital contributed. Whereas those LPs may get vastly different losses if we follow the reverse order of distributions upon liquidation. And so this is a really important thing to read and understand, right? You can't even read the OA. You can't even read the operating agreement kind of single-handedly. You have to also look at what did the LPs expect up front, right? What was promised to them in the private placement memorandum or the pitch deck or whatever you wanted, or what were conversations about? Right? And quite frankly, practically, what does the biggest LP expect? What does the biggest investor expect his K1 to look like? And the operating agreement should really mirror that, what was promised, so you're not misrepresenting what you're going to sell to the LPs or have them invest in. So allocations of income and loss is like the number one thing I'll always start with. And so that's like the primary chunk of the capital stack that I'll spend, and really making sure it aligns with what is going to happen. The second bit is then also in this capital stack is like a preferred return. And preferred returns are or can be construed as what's called a guaranteed payment for taxes, for tax purposes. That means a priority distribution if certain language is in the operating agreement such that the preferred return is paid without regard to income of the partnership, available cash flow, a couple of these things where it really makes it more really fixed and determinable. It treats, the IRS advises tax preparers to treat that distribution as income to them, as what's called a guaranteed payment. And this gets reported on a separate box of the K-1. This goes in box 4. And so box 4 would be subject to self-employment tax. And so you could have a mismatch. You could have a box 2, if it's a real estate deal, box 2 of rental loss, but a box 4 of income. And that box 2 could be passive, box 4 is not passive. And so you create this mismatch. Now they got cash for it, so not everything is awful, but it creates a mix match. Whereas if there's softer language in there or language in consideration of, based on available income of the partnership, in other circumstances, you may be able to argue that, this is just a distribution of their capital, of basis, what have you. And so things like that, we also look at how can we rephrase that? What's the intention again? What do the partners expect? And then the other little bit is non-recourse debt. And so to the extent the partnership will ever have non-recourse debt, you need to have a couple of terms in there that talk about how minimum gain and minimum gain chargeback work. And minimum gain is a function in subchapter K, as a function in the partnership tax world that actually allows excess losses that are financed by non-recourse debt to make their way to partners and to be taken by partners for non-recourse debt. What I mean by that is, let's say, for example, a partner contributes $100,000 to a partnership, to a real estate rental partnership, and that partnership then takes on additional debt to buy the building. You call it, 30% was the raise, 70% was the debt. Well, if they bonus depreciate the acquisition of the property that year, we may have losses going to that partner because we have bigger basis than just the capital. You may have losses going to that partner in excess of the $100,000. And so how that excess over $100,000 loss goes to which partner depends on this language in the operating agreement. So if we want to make sure that non-recourse debt is allocated to partners and limited partners, we just need to make sure that the operating agreement has those terms in it to respect minimum gain and minimum gain chargeback. I won't go into a full-blown explanation of how those work and the mechanics of it, but just know it's there and know it's important, especially when there's non-recourse debt, specifically qualified non-recourse debt that provides basis for these partners to potentially take additional losses in excess of their capital contribution. So that's kind of my capital stack chunk. Let's talk about events. What events should we consider, should we document, should we have included in the operating agreement or consider when we're talking about it? And the first one is a promote. And so I talked about it. A promote is a carried interest. And this is the special way that general partners or syndicators or sponsors, however you want to say it, can get paid in a special way out of a partnership. It is a special allocation of income. So it's usually a special allocation of distributions that are available if certain hurdle rates have been met, or income, return on investment, or IRR, however you want to calculate it. And so based on those distributions, well, the tax impact has to follow those distributions. And what we want to make sure is done here is that the tax impact is predictable and the promote is protected, right? We don't, if that partner if the GP gets a promote, we want to make sure they're getting the tax impacts to protect our LPs and to make sure that the promote is protected and available for them. So a lot of the times I'll encourage using what's called Rev Proc 9327. It has safe harbor language. And it's a great reference tool when you're trying to look at how to structure your promote and what it should consider. And it walks you through a couple of criteria, right? You want to make sure you're not getting into a fixed stream of income that could be taxable, right? We don't want these promote at grant to the sponsor to be taxable. It's a zero basis at grant is the whole premise of it. But after hurdles are met, it is earned and the promote then gets paid out. And the upside can be eligible for capital gain on a sale. And so these are really valuable tax ways that real estate sponsors get paid and can structure payout. And so we always encourage including profit interest safe harbors in the operating agreements just to make sure, again, I mean, you have to follow them, make sure they're aligned with it. And the other bit on the events thing is what's called a promote crystallization event. And again, I won't go too far into detail, but a promote crystallization is kind of this, can be, based on the type of income allocation and loss allocation method, can be a phantom income event to sponsors. And what a promote crystallization means is that the pref that maybe some higher priority capital is getting kind of gets frozen and taken out. And usually what happens is a promote crystallization is when a sponsor says, hey, I've done the CapEx, I've stabilized the property, I've done what I was supposed to do. I shouldn't pay you, the large LP, I shouldn't pay you additional risk-based returns, pref, on your investment, because look, it's stabilized, I've done my job. And so what happens is they kind of go through this hypothetical sale and this valuation is done, and the promote or the sponsor gets a percentage of the real equity. And future distributions will follow that real equity assignment. Well, that can create income to the extent if you have for example, a target capital account allocation where now they have real capital, right? They're granted real equity ownership in it up to their percentage of the valuation of it that they're allowed for. Well, when we do that, when you have a target capital account allocation method, you have a promote crystallization method, you want to consider where you're going to use things such as a cost segregation study. Right? And so this may not need to go in the operating agreement at all, but it should be an understanding and a timing of when to cost segregate this property. Cost segregation can help when you have a promote crystallization clause to offset those costs, right? Because now all of a sudden, sponsor now has real equity capital in the deal, in the capital stack, so a cost segregation study would benefit them much more than it would at the beginning pre-crystallization where they can't use it. And so this is just something I look for. I look for a promote crystallization clause. I look for income allocation. And I say, okay, well, when are we going to cost segregate this? Again, make sure your recourse debt, your non-recourse debt language is in there to make sure that we can do what we can to save our clients money in this phantom income event. So those are my events. Last bit is the best practices. Again, I talk about this thing called unreimbursed partner expenses. Unreimbursed partner expenses is, you may not know, you might not remember, but right, a couple of years ago, President Trump went under audit, and I forget how much, it was like $20 million of these unreimbursed partner expenses. So when you're a partner in a partnership, and the partnership doesn't reimburse you for costs or expenses you paid for in relation to that business, you're still allowed to deduct it. It doesn't work this way with S-corps. It does work this way with partnerships. And so Trump had taken a lot of deductions based on partnership income that weren't reimbursed. There has to be really specific language in those operating agreements to make sure that those things are specifically unreimbursable. Now, famously, the IRS said we're not going to read all those operating agreements. It was hundreds and hundreds of them and kind of just waived it. But you shouldn't do that. You shouldn't rely on that. You shouldn't expect that. So your operating agreement, if you're going to use this tax strategy, should be very specific on what you will not be reimbursed for in the partnership. And then the last bit I want to talk about on best practices is anytime we have different entities besides a partnership, we have to be really careful what type of language is in there. So the other two I'll talk about is the S Corp and the TIC, what I mentioned earlier, or the tenancy in common. And so, partnerships, operating agreements can get really long, and a lot of times S Corps, people may go from a partnership to an S Corp and then just drag on the entire baggage of the partnership operating agreement. Shouldn't do that, right? S Corps cannot make the operating agreement cannot make any mention of capital accounts 704B, which is the IRS audit or the IRS tax code section for a lot of partnership capital accounts. special allocations, preferred returns, non-pro-rata distributions. Like S corps have to be pretty tight on what they mention. They have to be an S corp. They have to not make any mention of a partnership, or they risk blowing up their S election. They risk blowing up their entire presence as, or the entire existence as an S corp. And when you do that, when you blow up an S corp, you're not left with just a partnership or a single member LLC. You're left with a C corp with unfiled tax returns. And so anytime you're going from partnership to S corp, or even just straight up S corp, and you're using an off-the-shelf OA, an operating agreement, again, make sure there's no reference to these partnership-like terms. And so the last, again, the other bit is the tenancy in common. So tenancy in common is used a lot with a 1031. And a tenancy in common, think of it like a joint venture, more like a joint venture treatment into rental real estate. And so these have totally separate rules as well. A tenancy in common is not a partnership. It can't be. There's a RevProc 2002-22. I'm trying to find the reference code. I think that's what it is. The IRS gives us, I think it's like 15 or 20 items that safe harbor you into a TIC agreement. And so you should read those and follow those. And so if you're rolling over a 1031 into a TIC, your TIC agreement needs to be pretty specific on what it includes in there, right? How are distributions calculated? What does control look like? What tax returns won't be filed? What's available exit, and what percentage do you own? So all these must be followed to be a TIC and stay a TIC, and again, protect your 1031. So I've got 11 of these that I talk about in this week's newsletter. You should go find it. Look at my plug-newsletter.com. Find $1 million checklist for operating agreements. This is what I'm calling it, because it has saved my clients millions of dollars in forward-looking advice. And so every time my clients get an operating agreement, they know to send it to me. They know I'm going to look at it. They know I'm going to pay attention to what's there, what's not there, and how does this impact you. So I hope this was helpful. Reach out to me. There's my newsletter, plug-newsletter.com. You can find me there. You can find me on X or Twitter, r.ledbettercpa. I'm on LinkedIn a little less, but I'm still there. If this was helpful, I'd love to hear from you. Subscribe if you don't subscribe already. Drop a comment, drop a like. Kind of helps me track what's working, what's not working. So we'll do it again. Thanks.